Welcome back to WealthWire Global. Today, we are unpacking a massive puzzle right in the heart of Dalal Street. I'm talking about a truly bizarre disconnect surrounding one of our absolute leading tire manufacturers, Apollo Tyres. The fundamentals are telling us one story, but the stock chart? Well, it's screaming something completely different. So let's just dive straight into this explainer and see if we can decode the Apollo Tyres paradox.
I mean, look at the sheer contradiction we are dealing with here. I've got to ask you, how does a company post a massive 14% revenue jump in its latest quarter, aggressively slash its debt, and yet watch its stock get absolutely hammered by the broader market? It is a genuine paradox. On the one hand, you have this incredibly robust corporate performance, and on the other, a stock that feels like it's in freefall. We are going to tear into the data today to find out exactly why this is happening.
But real quick, before we get deep into the numbers and analyst reports, here's our standard disclaimer. This explainer is strictly for educational and informational purposes. Always make sure to consult a SEBI-registered financial advisor before making any of your own investment decisions. All right, with that out of the way, let's look at the evidence.
The contradiction here is super stark. Apollo Tyres stock recently plunged to a 52-week low of 373.4 rupees, slipping below all of its key moving averages and really heavily underperforming the Sensex. But wait, counter to that green price action is a stellar short-term revenue growth of 14% in Q4, bringing their revenue to a really impressive 73.4 billion rupees. So that establishes our market mystery right there. The business is growing, but the valuation is shrinking.
And listen, this wasn't just some lucky one-off quarter either. The consolidated revenue trend shows a steady, consistent year-over-year growth trajectory. They hit 77.4 billion rupees in Q3. That was an 11.8% gain, and then followed it right up with that robust 14% growth in Q4. We are looking at sustained, double-digit top-line momentum across their operations. This is definitely not a company struggling to find buyers for its products.
Clue number 1, sector growth and market leadership.
To solve this mystery, we have to look at Apollo's absolute iron grip on the market. They hold a massive 30% market share in the highly profitable Truck-Bus Radial, or TBR, replacement market in India. What's equally impressive is that management successfully arrested a slight market share decline they experienced earlier in the year. In fact, recent data shows the TBR replacement segment actually delivered its highest ever quarterly volumes. I mean, they are a literal juggernaut in the commercial space.
But it's certainly not just commercial trucks. In the Passenger Car Radial, or PCR replacement market, Apollo commands a very solid 20% share. And there's a major premiumization play happening here. Their European brand, Vredstein, just reported its best ever quarterly performance, pushing their ultra-high-performance tire mix to over 52%. By focusing on these premium segments, they are structurally enhancing their margin profile, even when underlying tire demand in Europe has been, honestly, kind of sluggish.
Clue number 2, scaling up for the future.
So, how do they plan to sustain that 14% short-term growth and actually hit those ambitious long-term compounded annual growth targets? The answer lies in one bold number, 58 billion rupees. Management has formally announced a staggering 58 billion rupee capital expenditure plan slated for FY27 to FY29. You simply do not commit this kind of capital unless you have unshakable conviction in future demand.
Where exactly is this 58 billion being deployed? They are massively expanding capacities. They're going to add 105,000 tires per day for passenger car radials, which is roughly an 18% addition to their current capacity. Simultaneously, they're adding 3,600 tires per day for truck and bus radials, giving them a 20% capacity boost there. And the absolute best part for investors, they plan to fund this massive scale-up primarily through internal accruals and highly manageable debt. This capex is essentially the engine they're building for long-term growth.
Let's just pause and recap for a second. We've got record revenues, dominant market share in highly profitable segments, and a massive, fully funded expansion plan. So, what on earth is Dalal Street missing? Why the vicious sell-off driving the price down to 52-week lows? Well, it's time to pivot the narrative and uncover the hidden headwinds that have thoroughly spooked retail and institutional investors alike.
As we know, the market is a forward-looking discounting machine, and right now it is heavily fixated on 3 massive headwinds. First up, severe raw material inflation. The price of natural rubber has spiked violently, jumping from an average of 200 rupees per kg up to 250 rupees per kg. That is high-teens sequential inflation. Second, the broader European demand environment remains sluggish. And third, there's a short-term restructuring drag. The company had to make a 55 million euro cash provision for shutting down the Enschede plant in the Netherlands to smoothly transfer that production over to Hungary and India.
But hey, before you let those headwinds scare you out of the story, you have to look at the actual balance sheet data. Despite these intense raw material fears, Apollo's profitability remains incredibly robust. We are talking about an amazing 34% overall profit growth here. They have aggressively slashed their net debt to EBITDA ratio down to a remarkably lean 0.4x, down from 3.2x back in 2020. With proactive 6 to 8% price hikes in India to offset that rubber inflation, this balance sheet is practically a fortress.
The verdict: valuation and price targets. When we finally compare the market's current bearish reality with analyst projections, a massive valuation gap emerges. Even in a worst-case bear scenario, where macro headwinds persist and earnings miss the mark completely, the price target drops to 400 rupees. But the general analyst consensus? That sits at a highly attractive 650 rupees, assuming just moderate growth. And with strong earnings and sector tailwinds, the bull case points all the way to 780 rupees. Think about that for a second. At 373.4 rupees, the stock is currently trading completely below the absolute worst-case scenario. Crazy, right?
And to firmly reinforce this perspective, top-tier brokerages are holding the line. Motilal Oswal recently reiterated their buy rating on Apollo Tyres, explicitly stating that valuations appear highly attractive, especially when compared to their industry peers. They forecast a 21% PAT CAGR moving forward, driven by margin expansions and a strong pickup in India revenue. They are flat out telling us that the underlying business is fundamentally outperforming its battered stock chart.
So, we want to leave you with this final provocative question. With the stock scraping a 52-week low of 373.4 rupees, is the market wildly mispricing Apollo Tyres' future? Is this one of Dalal Street's biggest mispricings, or are those fears around rubber inflation fully justified? We would absolutely love to hear your take, so let us know in the comments below. And if you found this explainer helpful in cutting through all the noise, please hit that like button, subscribe to WealthWire Global, and we will see you in the next explainer. Happy learning!